Ron, good to see you. Good morning. And good morning to the rest of you. Hope you're ready for a great day. I am. I'm excited. It's been a good morning. I woke up. Always a good morning when that happens. Guys, we're going to go through it. We're going to do what we do. We're going to look at stuff. We're going to talk about things. Hey, Steve. We are going to embrace patterns and learn a little discipline, maybe. Who knows? One of the first things I do every morning, guys, and this is an important part of my morning routine, is I go to forexfactory.com/calendar, and I'm just looking for news. I'm looking to see what's going on in the world that could disrupt the patterns that I'm trying to trade. Today is Friday, April 25th. Hey, good afternoon, Miss Jen. And at 10 a.m., we've got a revised University of Michigan consumer sentiment. It is a medium impact affair, which means that it could move the market a little less likely than high impact. But I'm going to keep a note on my desktop, and right around 9:58, guys, I might say, all right, if I'm in a position, I need to protect myself because it could go a little crazy. Ron, you'll do patterns, you hate discipline. Man, I hate to break it to you, but your patterns are discipline. That's how they trick us. All of us rules breakers, we realize that the rules work, and we're like, man, I got flim-flammed. Hornswoggled, if you will. And then, y'all, everything that I talk about, it's going to come from the Nexgen page. I know I've still got some new names in here, which is awesome. Guys, I promise you there's no secrets. There is no holding back. There is no let's give them a little and charge them for more. Guys, Nexgen is dedicated to your success. And when you go to the education tab in the trading guide, all the rules that I talk about each and every day, they're here. They're right here. You don't have to have a secret handshake or knock on the door, right, to get it to open. Everything that I talk about every morning for an entire hour is high probability trend trade. And we talk about high probability trend trade for a reason. It's a trade that typically wins 70 to 80% of the time. What's the goal of trading? The goal of trading is to win more than you lose, to put more in the account than they pull out. So having a pattern, and that's all that this trade is it's a pattern that's been proven to win more than it loses. It is testable. It is verifiable. It is repeatable. And you just have to learn it. And that's what we're going to do this morning. The lag on price at the last trade yesterday, fixed it. Don't know how. I don't know what that is. Did you just get slipped? Went so fast you got slipped? Slippage happens. I'm not sure if I understand what the lag was on that last trade. It looked good to me. 4 lots straight up, right? Now we're going to do a little research. Oh, so on that one, Ron, your exit's at 21.7, 21.7. You got slipped, brother. It was just going so fast. NinjaTrader couldn't keep up. That happens sometimes. That's a great problem to have when it goes in your favor. Yeah, no kidding. Guys, we're going to talk about this high probability trend trade for one specific reason. It's going to teach you to read your charts. And I know that I sound like a broken record, and to be honest with you, I'm okay sounding like a broken record. Because chart reading is 90% of your day. And man, I'm talking to Aaron and BJoy, and you guys that are new to this. 90% of your day is doing nothing. 90% of your day is sitting on your hands. I play Scrabble. I play video Scrabble off on a different monitor when I'm waiting for my rules to be met. And 10% of your day, and that might even be a high estimation, is actually trading, is actually getting into the market and either making or losing money, whatever happens on that particular trade. So from day one, believe that there's a lot of doing nothing in successful trading. And you'll know when it's time to embrace that 90% by learning to read your indicators, by looking at the information they're giving you. And once you get good at it, and it won't take you long to get good at it, I'm going to give you the recipe to get good at it sooner than later. You'll understand where the market is likely to continue. And that continuation point initially is the entry for the highest probability trend trade. Those continuation points may change over time and become momentum trades or high volume area trades. But we're going to focus on that high probability trend trade first and really defining where the market is likely to continue. You'll understand where the market is likely to go. These are those key Fibonacci areas, and they make great targets when you have the advantages. And then finally, you'll understand where the market is likely to stop. Let me get my pew pointer. And likely to stop is a termination condition. And it's right there in the name, guys. It could terminate a trend. It could stop the market's forward progress. It could create big, ugly bounces. And you're going to know where they are before the market ever gets to them. And you're going to know how to gauge whether or not they're problematic when the market arrives. So I want you to focus on being a chart reader initially. And then it's only 3 rules to be able to do it. It's only 3 rules to find this high probability trend trade. Each rule, when true, creates an advantage. And you know, it was funny. Maybe not funny, haha, but I spent the better part of the morning chatting back and forth with John Novak, the gentleman that created the software that wrote these initial rules. And what I found is that every conversation we had about the market, every conversation that we had about what we saw and what we were doing and what was good and what was bad, they went back to these 3 rules. He's been doing this for nearly 30 years. I've been doing it for over 5. And every time we talked about a problem on our chart, we mentioned either momentum or path, to be honest with you. And I'm going to tell you right now, guys, if you learn momentum and path, if you focus on these first 2 advantages from the first 2 rules, what happens is it opens doors for a million opportunities, and it creates an enormous level of patience to keep you out of trouble, to stay away from avoidable losses. The 3rd rule is an entry rule, and it's just designed to get you into the market. It's designed to put you into the market where the market is most likely to continue for this highest probability trend trade. You feel a nickel coming? You might. 3 rules, that's it. Simplicity, guys. I'm not smart enough to go to 4 rules. 3 rules. It happens on only 2 charts. The first chart is a large chart. It's a big chart. It's a slow chart. This large chart is a very broad stroke of a brush. It's very difficult to see change on. But you're going to allow the large chart to define the direction of the market, letting you know whether you should be looking for long or short trades. And if you're new to futures, congratulations, you can make money both directions. You're going to let the large chart define the momentum in the market. Rule number 1, giving you that first advantage. And you're also going to let that large chart to define areas, the areas that could be problematic, the areas that could create a bounce, the areas that could cause trouble. Your first 2 rule, giving you momentum, giving you a clear path, that core, that foundation that we're building, guys, you're going to recognize both of these on the large chart. And you're going to recognize it in only 1 bar. That's all it takes. The most current bar on the large chart will be able to define direction, momentum, and areas, guys. That's a lot of work just in 1 bar. But 66% of your advantages, 66% of the good stuff just comes from that little read right there. Once your large chart says go, once your large chart says, hey, guess what? You do have momentum. Your path is in fact clear. You're going to turn your attention to a smaller chart. This is a faster chart. And it's very much a refinement chart. And I'm going to show the picture today because I feel like I should. Inside 1 bar on the large chart, inside that 1 bar that's showing you direction, momentum, and area, guys, is 20 to 30 bars typically on a smaller, faster chart. 1 bar on the large chart, from the very bottom to the very top, is a full pullback and very often a bounce and a continuation. And it's this refinement process on a smaller moving chart that's going to have you pinpointing precisely where the market is most likely to continue. It's going to allow you to reduce risk. It's going to allow you to increase profit potential. And rule number 3 is nothing more than helping you identify where the trend is most likely to continue. So we use 2 charts. I pulled this out yesterday and I realized how important this analogy is to what I do, or this metaphor, excuse me. Ask yourself, who are you trading with and who are you trading against, guys? And if you're trading with the large chart, if you're allowing it to lead the way, you're trading with the big crowd. You're trading with the men and women, the institutional traders, the people with all the money and the ability to create trends and momentum, and you're just going right along with them, letting them do the hard work and then capitalizing. The large crowd typically wins. Your entry chart, like to think of it as the small crowd. These are the fighters. These are the dukes up, ready to scrap. And when the large crowd says up, they want to say down. And when the large crowd says down, they're dying to say up. They love to fight. But guys, they lose their fight typically 70 to 80% of the time, which means that when you let the large chart lead the way, when you have those 2 advantages and you pinpoint your entry on a smaller, faster chart, what you are pinpointing is where their fight is most likely to be lost, which also happens to be right where the market is most likely to bounce and continue with everything that the large crowd wants. So let it be 2 charts. Let the large chart lead the way. Remember that your small chart is nothing more than an entry chart, and it should only be looked at when the large chart tells you that it's time to go. We will spend the next hour, the next 45 minutes, 53 minutes, I don't know, it's going to be somewhere in that range, and just learn the trigger line and the Fibonacci rules for when it's okay to trade. I believe that phrase, when it's okay to trade, is important because it's okay to trade when my rules are met. Because my rules are describing a pattern that repeats itself in the market. My rules are describing a pattern not only that repeats itself, but I can prove wins more than it loses. I can prove that when I have momentum, a clear path at an entry area, I am more likely to win than I am to lose, which means that I have an advantage or an edge. And I'm trading the edge. And if my edge isn't present, I choose not to be in the market. All of you have the ability to simulate. Simulator is amazing. It's the batting cages. It is the driving range. It's practicing free throws, guys. You can't lose a championship. You can't lose money on simulator. All you can do is get better at your craft. So simulate, practice, learn to read these indicators. And then the first step in becoming a confident trader ASAP is post your trades in the room, guys. Take a second. Show me what you see. Show me why you did what you did. Tell me on your chart why you did what you did. And what happens is every time you post in the room, you get a private session with me. That's the easiest way to say it. Everybody wants one-on-one time. You get it. All you have to do is post in the room. And this is what I ask. Every time you post in the room, do me the favor. I want you to show me both charts, because what we do is a 2-chart endeavor. And I want you to point out, I want you to use arrows or boxes, and I want you to point out momentum and tell me what you saw. And I want you to define your path and tell me what you saw, and I want you to define your entry. And I ask you to do this on the charts, not because I can't read your charts, guys. I know exactly what you're doing, and it's a little scary. I know exactly what you're thinking. But you're going to go back and study your trades, guys, and this is going to build pattern recognition. And you're going to learn to trust your rules. And you're going to see the things that are creating success for you. And you're going to associate these looks, these patterns, with positive things, with good trading, with great results. But you're also going to recognize patterns that might be pulling that success from you. Whether it's trading into areas or whether it's trading without momentum or getting in on the wrong side of triggers. So if you'll do that every time you post in the room, you're going to get my undivided attention. And we're going to go through everything that you see and everything that you did. We're going to celebrate victories. Guys, I love to celebrate victories. I'm such a hippie. But we're also going to point out the challenges and work around them and figure out how to correct them. So don't hold back on posting in the room. You can't post too much. And the cool thing is, is that's what makes the class great. When you guys start posting in the room, when you guys start showing me what you're doing, it creates lessons for the entire classroom. And the best classes that I ever have are the ones that have the most posting in them. So we're going to simplify. Have I mentioned that? Only 2 charts? Only 3 rules? It doesn't have to be difficult. Most people try to make it difficult. One of my favorite Elon Musk quotes is, he goes, man, engineers are a pain in my ass. They're always trying to optimize things that shouldn't have been built in the first place. And guys, day traders are always trying to optimize things that already work, things that have been proven to win more than they lose, because we have this natural desire to want more, and I don't know what it is. Simplify initially, guys. Focus on the high probability trend trade. I'll hand you a written plan, a plan that discusses the entry for the trend trade, that talks about how to manage the trend trade. And then it includes a second trade, a trade that relies on your ability to read your charts. You have to learn what looks you'll commit to. What does it look like to have this best of the best trade? What's the pattern that I need to look for, knowing that I have an edge each and every time I trade the market? You've got to learn them so they look easy. And they become easy through repetition, guys. Repetition is the key to recognition. And that's the second piece of the puzzle. The second step to becoming a confident trader ASAP. It says track your real-time performance in a spreadsheet. Guys, I give you this spreadsheet every day. And it used to be nothing more than a trade tracking tool. That's the 4th tab. It used to be nothing more than a place to put your charts, to talk about your advantages, and then to have a little notes section about the feedback you received in class. Because honestly, you're not expected to know what you did right or wrong as a brand new user. That's my job, is to tell you, to help you with that. So the feedback from class, every trade you take, guys, we're going to talk about the good and the bad. We're going to talk about what's right and what's wrong. And everything that's right, we do celebrate. And everything that's wrong, and it's okay to be wrong as a new user, you get how to fix it. So throw your feedback in here, guys. Tracking your real-time performance is how you begin to recognize patterns. I've made a lot of additions to this spreadsheet to help you do just that. The first one is the basic rules. It's those 3 rules in green, what it looks like to have them met. And each of these pictures is not only a picture of strong triggers, but it's an annotation describing why they're strong and what it means to you. The same is true with weak triggers, because if I'm focused on only trading when my advantages are present, I need to know what it looks like when they go away. Clear path, terminations, and entries. All of this is a study tool, and I'm going to give you a sheet to help you begin to fill it out on your own to create that recognition. There is a client trade section. The client trade section is very much where I steal stuff from you guys. When you're using advantages, when you're taking these great entries, hey, good morning, Miss Cindy. When you're a rock star, I liberate it from the chat room and I put it into the spreadsheet. We're using this as a study guide for all of you. You can go back and start looking at these. These are trades like from completion, from entry to completion. And you'll find these common threads. You'll find the momentum and defining the entries. And guys, you can use them as a study tool. The third tab is where you're going to put all of your pictures. You're going to put the pictures when the patterns are true through your study so that you can commit them to memory. As you begin to take trades, you're going to realize that you have to manage them. I'm going to give you a solid management plan, but you're going to grow your own. As you learn to read your indicators, you'll grow your own. When you see reasons to hold longer, take pictures, put them in here, annotate those charts. When you see reasons to exit sooner, do the same thing. And you will begin to recognize patterns, guys. You'll begin to see things outside of this basic plan because of what you've learned in the plan. And then, Ron, here comes your nickel. The high probability trend trade, ladies and gentlemen, is not your only trade. It's your first trade. It's not your get-rich trade, guys. It is very much the trade that teaches you to see your get-rich trades. So as we move into this first hour, we will do exactly what we do every day, because repetition, repetition, repetition. Isn't that funny? I said it 3 times. Guys, learn the rules. Keep it basic. Understand them individually and how to piece them together to create a trade. I'm going to help you with that. That's my job. You need to simulate. You need to practice. Don't say things like, oh, I'll start simulating when I'm perfect at understanding the rules. That's nonsense, guys. You're going to be in a constant state of growing for the rest of your life. Get in there and break some eggs. Throw those pictures in the room. Get that private session with me. Keep it simple. Keep it focused. Keep it basic. Learn how to be patient, guys. Beautiful trading, successful trading, consistent trading is a boring, ugly endeavor, but the money is not. Learn the looks. And that's exactly what we're going to do, is we're going to learn the looks. And we're going to start with the indicators, guys. And I am on the wrong little thing here. Hold on. Here we go. Let's start with the indicator. So if you're brand new, you're opening up the software, you're like, what the hell am I looking at? Well, you're going to notice triggers on both charts, both time frames, guys. There are small triggers. They're two solid lines. They work together. They're a fast-moving average. When they're going up, they're green. When they're going down, they're red. And small triggers look the same on both time frames. There's also large triggers. Those are the big, fatter dashed lines. And large triggers are a slower moving average. And if they're going up, they're green, and if they're going down, they're red. And they look exactly the same on both time frames. You only need to know the difference between small and large, because you're going to use these triggers to define momentum, and you're going to use these triggers to define those termination conditions, and you're going to use these triggers to define your entries. Triggers will show up in everything you do, guys. Learn how to read them. And then both charts have areas. I like to say areas or horizontal lines on a chart. That's the easiest way to think about it. They all have names, but we're going to use them differently depending on the time frame. There are divergence highs, and this is a magenta line. And if the market is pushing up and then it slams the brakes on, goes the other direction, if there's a loss of momentum at that pivot, you'll see this magenta line print. You'll see it as a cyan line from a low. So every time you see a divergence line, I want you to say the market was losing momentum there. And that's it. That's little synonym. You're going to see Fibonacci resistance. It's a red line, runs horizontally. You're going to see Fibonacci support. It's a blue line, runs horizontally. You're going to see these yellow one-to-ones. These yellow one-to-ones never change color. These yellow one-to-ones are like Fibonacci areas that print live in the moment. They're 100% Fibonacci alternates, and I'm going to tell you, the people that control the market use them. So when these show up, you're going to learn to respect them. And then finally, there's the midband, and this is just an exponential moving average, and it's going to squiggle through your chart all day long. When price is above it, it's green. It may act as support. When price is below it, it's magenta. It may act as resistance. You don't have to know how to program these or what the numbers are that make them be. All you have to know is how to name them. On the large chart, these are the areas that could stop the forward progress of the market. These are the areas where the large crowd is making decisions. On the small chart, these are the areas that could create a bounce to continue with the trend, and you're going to define great entries using these areas and those trigger lines. Good morning, Cav. Nice to see you in here today. Over the next hour, 30 minutes, 40 minutes, I don't know. Ask a million questions. We'll make it last 3 hours. I don't mind. We're going to talk about each of these rules individually, how to identify them, and what they mean to you. So we're going to start with the large chart because the large chart leads the way. And we're going to look for strong trigger lines. We're going to look for the advantage of momentum. And in order to have momentum, you must be trading with the trend. So if the background is green on your large chart, the trend is up. We're going to look for rules to be met for high probability trend trades long. And if the background is red on your large chart, the trend is down. And we're going to look for rules to be met for high probability trend trades short. And this is kind of a little cheat code because the only way that you can have strong triggers is if you're trading with the trend. So strong triggers in an uptrend, what it means, and the look, means that your small triggers are up and above your large triggers. Your large triggers are widening, the smalls are above. And guys, it's this space that's created between the small and large triggers. It's that gap between the two. That's your strong trigger look. And it's a strong trigger look on a large chart or a small chart. Momentum is momentum. And it has nothing to do with the price bars. And it has absolutely nothing to do with those areas. It is nothing more than a separation of the triggers when all the colors match. In a downtrend, your smalls must be below the large must be wide, and it's the space between that lets me know that I have strong triggers. And when I have strong triggers, this is my favorite phrase, the odds are favorable for the market to continue in the direction of the trend. The odds are favorable. That should create like this warm fuzzy feeling inside of you. OFM is what you're going to see annotated on charts. I have odds favorable momentum. This market is likely to continue in the direction of the trend. Odds favorable momentum is what we're looking for when we're looking for the potential to break those key Fibonacci areas. Odds favorable momentum. This is going to be your look when you're taking entries, guys. On that big slow chart, it looks like these bars sprout a tail. These tails are those pullbacks on the small chart. You're going to be able to pinpoint through rule number 3 where these tails are most likely to form. You're going to be able to use that idea to go back and study this methodology. And guys, one of the greatest things about odds favorable momentum is it's so hard to stop on a large chart that it'll even cover some of the mistakes that you make as a new user. So I'm going to share this picture today. This is rule 1. Whoops, we forgot to talk about the other side of the coin. When the small triggers work their way inside of the large triggers, I got ahead of myself. Guys, this is strong because there's space. This is weak because there's none. It's very black and white. If you have a gap between the two and the colors match, you have odds favorable momentum. If the small triggers work their way inside of the large triggers, you have weak triggers. And when weak triggers are present, anything can happen up or down. When you see charts annotated in this room, you're going to see OFM very often with this separation. You're going to see ACH when the separation is gone. So let's go back to that picture that I almost showed too soon. The market is moving down, is pushing down. Life is good, but we get weakness. And that's that anything can happen trigger. And you'll notice that's where the reversal comes from. And this chart doesn't even have the areas, guys. So weak triggers, there's your reversal. And from that weakness sprouts strength, odds favorable momentum. There's one of those tails, a potential entry for a high probability trend trade long. And it continues up back to weakness where the next reversal happens. And it flows into strength. And then we get that indecision. And there's a gap. There's a waiting period in between those tails, in between those trades. And then when the large triggers are down, but the small triggers are up, or the background is green and the triggers are red, guys, this is where the buyers and sellers, the men and women that control the market, they're fighting. They're fighting for supremacy. They're fighting for direction. They're fighting to create momentum. And you don't ever have to be a part of their fight. This is what you experienced traders call chop or consolidation. And if you have any time in the market, you know that chop and consolidation can drain an account quickly. If the colors don't match, guys, sit on your hands. Don't try to predict it. Eventually, somebody's going to win, and they're going to create that momentum for you again. So if I open up a large chart, there we go. Perfect example. Smalls are above the large and space between. Can you give me a Y if you see that momentum? The most current bar, the first bar, is letting me know that the odds are favorable for this market to continue up. Are you guys with me? Yay! Thank you, Aaron. But guys, that's only rule number 1. That's only 1/3 of the equation. So momentum is great. Momentum pushes a market. But now we've got to make sure there's nothing in the way to stop that market. We have to make sure that termination conditions are false, that we have room to our profit targets. We'll just call it a clear path because let's be honest, I don't want to type that much every time I'm writing my rules on my chart. So I have momentum. Let's make sure the path is clear, guys. What can stop a market? Horizontal line on a large chart. Areas. These are where the decisions are being made, where the buyers buy and the sellers sell, where fights happen. Guys, this is where big ugly bounces occur. This is where fights are going on. This is where reversals are most likely to come from. So if the large crowd is making decisions at these areas, the first step in defining an area as a trouble spot is let the large chart get there. I told you guys you would understand where the market is likely to go. These key areas are where the market is likely to go. And once the market gets there, once price reaches resistance, the only thing you have to do is ask yourself, where are my triggers? Because once price reaches the area, that's what sets off the decision making. And the trigger lines will tell the story. We no longer refer to price. We go straight to our trigger lines to understand if it's a termination condition. If both small and large triggers remain below the area of resistance, resistance is a termination condition. And guys, I'm going to tell you right now, every line that you reach on the large chart will be a termination condition, at least for a moment. And then the decision-making process starts. And there's 4 possibilities. The first possibility is that the area just breaks, that the market continues up, and that resistance has absolutely no effect because the sellers weren't interested and the buyers weren't taking profits. The second possible thing that could happen is it creates an untradeable bounce. Maybe there's a testing of the waters from the sellers. Maybe half the buyers take profits and you get 2 or 3 down bars, but then they decide to continue up. Those 2 to 3 down bars could absolutely ruin your good time and pull you out of any long position. It could fight. It could go into one of those moments where the buyers and sellers just duke it out. You don't want to be in the middle of that fight, guys. It's like 2 pit bulls and you're wearing ribeye underwear. It's a bad idea. Or it could reverse. That decision made at the key area could be so impactful that your large triggers go from green to red, that the market reverses, that it sends you going the other way. That's what we call a strong top. And a strong top is the precursor for the highest probability trend trade you could ever take. And a strong top, that no triggers through termination that reverses the market, that's rule number 1 for the second trade on the plan that I'm going to give you. So when price reaches the area, just ask, where are my triggers? And if they remain below, wait for the reaction. Rule number 2 is not met. Absolutely no trades into the area. And if it reverses, it's a strong top and the momentum is cranking and everything is hauling, and then it hits Fibonacci support. And once price reaches support, that's the first phrase in the rules. You ask yourself, where are my triggers? And if your triggers remain above support, both small and large, they're north of that blue line, there could be a fight. There could be an untradeable bounce. There could be a reversal. It could break. You will never know what the reaction is going to be, so your highest chance of success comes from doing absolutely nothing and waiting for the reaction. This is what it looks like when a termination condition reverses the market, when it creates a strong top, when it creates a strong bottom. This is what it looks like when it breaks, because that's one of the 4 options. But when price reaches resistance and your triggers are still below, your highest chance of success is to wait for the reaction, to allow it to break rather than try to predict the breaking. Remember that we're done with price. Once price reaches resistance, we're done with price. And until both your small and large triggers get above resistance, resistance is still in play. But once small and large get above that resistance line, resistance behaves as support. Your path is now clear. And guys, your path is clear until you reach the next area. Every line will be a termination condition when you reach it. And then once you can tell the difference between the two, once you understand the difference between a termination condition and a clear path, it opens you up for the second option, guys. And this is the second trade on the plan that I'm going to give you. And what it is taking that odds favorable momentum and that trigger line relationship to the fib and saying, my gosh, this fib has the potential to break because of that momentum. And you'll recognize it because the small triggers absolutely smash through the area. Not the price bars, the small triggers. And the large triggers are lagging behind. They haven't quite cleared to give you that clear path. Guys, this is what we call a 50-50 look. And 50-50 refers to the trigger location. If 50% of your triggers are through, but 50% are not, you have the potential with odds favorable momentum to break that area. But it's not clear, it's only potential, which means that any trades you take with this look must be managed assertively. Because just because the potential is there doesn't mean that it'll break. Price reaches support. Where are my triggers? My triggers remain above. It's a termination condition. I choose to wait for the reaction. I'm in control of whether or not I pull the trigger. I choose to not because I don't have a clear path. This potential, I'm very willing to take a trade. I know I must manage it assertively. But once I have a clear path and once I have momentum, guys, I can't wait. I can't wait to be in the market. So I want to go back and I want to see what's going on in the wonderful world of crude oil. And we'll just start up at the top. Weak triggers right at Fibonacci resistance, and the market pushes down. And they had the potential to break those one-to-ones, but they didn't. Look at the big untradeable bounce. Right back to resistance. Absolutely no triggers break through. And sure enough, that's where the reversal starting the downtrend begins. But when they get to this divergence low and the triggers don't break, there's a retracement. And that retracement goes directly to resistance that used to be support. Pretty cool, right? And then it continues down. And there's some of those tails and opportunities right until weak triggers hit support. Once again, you knew about the area and you knew about it for 3 hours. It didn't jump out at you. And then from support with weak triggers, giant retracement, and those one-to-ones had the potential to break, but they sure as heck didn't. And then the market continues down. There's another one of those tails. The area breaks. We get weakness. And the buyers try. Oh my gosh, they try. They steal the momentum from the sellers and they try to push up. And the sellers say, hey, we still have some profits to take. And they push all the way back down to that line where the buyers told them no. And look how it stops the market, how it reverses the market, and how it sends the market screaming up. And then there's one of those tails again, right on the potential to break. And it did break with all that momentum. And guys, that is about the greatest lesson on termination conditions you could ever get. That's a live market. That's today. I didn't go back and make this up. This is the market reacting to these key areas. So there's going to be times, guys, that these key areas are in your way. There's going to be times where you can't get a clear path because the areas are stacked. And I want you to be okay with that because this is 90% of your day. 90% of your day will be doing nothing. 90% of your day will be hoping for advantages, looking for reasons to take trades. And if you can't seem to get that clear path, you're going to learn to be okay not being in the market. Futures markets trade billions, is exchanged every day. Futures markets are constantly going up and down. There's constantly longs and shorts. There's all this volatility. It's amazing. And out of that billions that's traded every day in the futures markets, guys, all you need is 400. 400 and you are a six-figure trader based on your trading. So you don't have to trade into areas. You don't have to trade into support. You don't have to hope that the area breaks. You can allow it to break. If you can capture $400 trading away from Fibonacci resistance, trading to Fibonacci support, $400 a day consistently is a six-figure income, guys. Learn to be patient. It's a virtue, I'm told. One more termination condition. This is large chart and small chart. You'll see it on a large chart, guys. 3 divergences in the same price range may terminate a trend. I think we had a beautiful example of that on crude oil. We're at the very top of this trend down. 1, 2, 3, 4 divergences. 4 losses of momentum in the same price range. And that's what set the market in motion going down. You'll see it on a large time frame, typically bigger moves after it. But if you see it on the small chart, if you see it on that entry chart, it's showing you change that you can't see on the large chart. 3 divergences in the same price range may terminate a trend. When you see it on the small chart, it's giving you a heads up that slow moving large chart is experiencing some change. And you may have to just pump the brakes and wait and see what happens. And that's the only time on a small chart that you should ever say to yourself, I will not take the entry if I have momentum and clear path. So that's termination conditions, guys. Termination conditions is the most broken rule among new users because termination conditions force you to do absolutely nothing if you are honestly following your rules and sticking to your plan. If I have these two advantages, my job is to go to the small chart, the fast chart, the refinement chart, the small crowd, and define my entry, pinpoint where the market is most likely to continue. And you're going to do that with such accuracy that you'll use a limit order. And this is pretty cool because you'll literally wait for the market to come to you at the point where the small crowd is most likely to fail. And you're going to use that limit order to buy or sell a pullback, that fight from the small crowd. And you're going to have that limit order waiting at an area, at a fib, at a mid band, or a yellow 1-to-1, because areas can create bounces. And our hope is that it creates a bounce in the direction of the trend from the large chart. And here's the most important part about your entry rules, and this is the one that I want you writing on every chart when you take an entry. You're going to take that entry at an area inside of triggers, guys, because triggers, as magical as they are, they define where that retracement is most likely to go. They define where that small crowd is most likely to take their fight. So your entry chart has the 5-1 large triggers. They're the smooth large triggers, dashed lines. But we've also put the large triggers from the large chart on your entry chart. And that's the 13-2. And we call these synthetic just because they're from a different time frame. One trigger line is not more important than the other, guys. It's the combination of the two that show where that small crowd fight is most likely to get. So you can start drawing boxes around these trigger lines, and this defines the most likely zone for the retracement. If you force them to be favorable large triggers, get that large and synthetic, one on top of each other, wide angled in the direction of the trend, what you've done is you have reduced the amount of space where that small crowd fight is likely to go, where that retracement is most likely to go. And then with fibs, mid-bands, or yellow 1-to-1s inside of that retracement zone, guys, that's money. That is low risk, tiny window, and it's amazing. The accuracy is overwhelming. So we're going to go and define an entry. We are going to insist that the large chart rules are met. So in this particular instance, guys, on this trade that we're walking through, my large chart is going up. My large chart is going up strong, and there is not a darn thing in the way. And it's going to look like this. That's your look on the large chart. And your small chart's going to be mirroring that. Your small chart's going to be screaming up. And you should have odds favorable momentum. And you're going to have this fear of missing out. You're going to be like, oh my goodness, the market's going up. It's going up fast. There's nothing in the way. How am I ever going to make money if I don't just jump in and hope it continues, guys? It's normal. If you do that, if you succumb and you jump in, here's your exit condition. The reversal bar. The reversal bar, the down bar, after all those up bars, guys, this is signaling the beginning of the retracement. The beginning of the fight from the small crowd, the beginning of the pullback, however you want to say it. And we know that price tends to return to large triggers because Mark says it every freaking day. So you have large triggers and you have synthetic triggers. Draw a box. From the highest line of the triggers to the lowest line of the triggers, guys, that's where the market's most likely to retrace. That's where the small crowd is most likely to push down. And the tighter those triggers are one on top of each other, the smaller that box becomes, the more accuracy you're going to have. But trigger lines are not entries. Entries come from areas. So once I identify where the market may return, I need an area inside of triggers. Areas can be fibs, mid-bands, or yellow 1-to-1s. It is a 3-area list. It is always a 3-area list. But they must be inside of triggers, all caps. That's the key, guys. You want a spot for a bounce inside of the retracement zone. So this box, from the highest area inside of triggers to the lowest area inside of triggers, this shows me where the market is most likely to bounce in the direction of the trend. From the large chart, this is pinpointing where the small crowd is most likely to fail. you're going to learn to trust that. And you're going to activate a limit order, a tick or two above that highest point of support. And you're going to do it a tick or two above because your large chart is railing to the upside with absolutely nothing in the way to create a bounce. And we don't want to trip over a couple pennies trying to save a few dollars, guys. So your limit order goes a tick or two above. And now you've done everything that you can do. You've done everything that you could ever be in control of. You can be in control of whether or not rule number 1 is met. And if it's not, you're allowed to not take the trade. And you can be in control of whether or not rule number 2 is also met. And you'll be in control of where that limit order goes and taking that entry, guys. And that's it. That's put your hands in the air, sit on them, pet the cat, whatever you need to do. You're either going to get an entry because they come back for you, or you won't. It's pretty simple. You won't be able to control that. But if you get the entry, if they do push back, if it reaches your limit order, you're in a long position. And you are in a long position with the advantage of a market where the odds are favorable for it to continue up because of those strong triggers. And you're in a position with absolutely nothing in the way on the large chart to stop that momentum. And you're in a position from precisely where that market was most likely to bounce and continue with the trend, guys. And this is your high probability trend trade entry. And we've just spent 30 minutes doing nothing but identifying 3 advantages that describe a pattern that has been proven to win more than it loses. Are there any questions about momentum? Are there any questions about a clear path? Are there any questions about defining the entry area? Of course not. Here's the cool thing. You've got to learn this pattern. Reversal bar begins the pullback. It's not your entry. Trigger lines define where the retracement is most likely to go. It's not your entry. Areas inside create a window from the highest to the lowest. This is where the market is most likely to bounce. Because of the large chart advantages, your job is to activate a limit order 2 ticks above it. You have pinpointed where the market is most likely to continue. Anything below the triggers, beyond the retracement zone, beyond the areas most likely to create a bounce, anything below those triggers, I call it the wrong side of the triggers. And when you get in on the wrong side of the triggers, you don't know if the market's going to continue up. You don't know when it's going to continue up, and you have no idea if it will even continue up. The advantage of rule number 3 is no longer in play on the wrong side of the triggers. Go in the other direction. Reversal bar begins the pullback is not your entry. Defining where the pullback is most likely to go with the large triggers, with the synthetic triggers. It's not your entry. Your entry comes from the area, from the fib, from the mid-band, from the yellow 1-to-1 inside of those triggers. And guys, 2 ticks below, that's your entry. And any line on the wrong side of those triggers is where my advantage is gone. And by defining where the market is most likely to continue, you now understand where the market shouldn't go if it's going to be one of those winners, where the market shouldn't get to if this is going to be one of those winning trades, guys. So your initial stop will be placed where the market should not go. And it's generally 4 to 5 ticks above those trigger lines. And you're going to be willing to accept that risk because you know that with momentum path and entry, it's more likely to go down than it is to go up. And it's more likely to go up than it is to go down. And anytime that stop gets hit, that's an acceptable loss. That's a cost of doing business. That's a part of doing business. You'll learn to not fear losses. You'll learn to get cocky and say they're going to have to come get me where the market shouldn't go if they want my money. And if they can't do that, I'm going to hold this position. And I'm going to stay in that trade. So how do I get good at it? How do you get good at it? I'm already good at it, guys. I did my study. I filled out my spreadsheet. This is how you're going to do it. It's not taking trades. Guys, taking trades is not the fastest way to get to where you want to be. Studying the looks, studying the patterns, guys. And you can do that historically. Anytime your large chart has momentum, anytime your large chart has clear path or potential to break, there's that pullback that we're not taking on the large chart. We're using a refinement chart to pinpoint where that tail is most likely to form. So if I just circle these tails and they line up with areas inside of triggers on my small chart, guess what? That's your pattern. That's the one that you have to go through and take a picture of. And that's the one that you have to annotate. And that's the pattern that you're going to go put into your spreadsheet so that you can study it every morning and know exactly what you're looking for. And that's really how you're going to get to where you want to be. So here's that large chart again. And I'm just going to, for grins, circle this tail because I had momentum and my triggers were all above the area. And what's it look like on a smaller, faster chart? Well, it turns out that it's a pullback directly to support inside of favorable large triggers. And ladies and gentlemen, this entry was 8 minutes ago. Can you give me a Y if you see it? Smalls are still outside. All my triggers are above resistance. It's behaving as support. Reversal bar, right back to support inside of triggers. And it did not go where the market shouldn't go. And currently in this particular trade, you're up about 140, 150 bucks per contract. This is the pattern, guys. And I don't have to load pictures and say, let me go find the one or two times this happens. I can show you in a live market that this is a pattern that repeats itself. And this is a pattern that repeats itself day in and day out. And sometimes you have to be patient. And sometimes it happens time after time after time. And the market's like a freaking ATM. And those are great days. Let's find this circle. Here's a look. And I like this one. Your areas are on the wrong side of the triggers. And if you thought you were going to get at the mid-band, you might have gotten stopped out because you're already where the market shouldn't go. And if you hope that resistance would hold, you might have gotten stopped out because you're already where the market shouldn't go. And guys, you got to be willing to say to yourself, I'm okay not taking this trade as a brand new user. My advantage is gone for entry. Then the same is true here. So not every tail is going to be a winner. Not every tail is going to fit your rules. But what you'll find is that if you continually scroll back, if you look for the clear path, if you look for the momentum, that potential to break, so often you're going to see these patterns setting up. Tried to take it, didn't fill. I don't know which one you're talking about. This one? You tried to take that one, but it didn't fill? Bummer. I would ask you, where was your entry? Where was your limit order waiting? Because if it was 2 ticks above support, I don't see how it couldn't fill. If you tried to beat the system and use the mid-band, maybe not. And if you tried to get in below, that's weird because it went 4 or 5 ticks below. I guess there just wasn't the volume to get you in. That's okay, guys. That's going to happen sometimes. Oh, you use the mid-band, not the highest area. So sometimes that would be that tripping over pennies to save a few dollars thing I was talking about. So guys, go back and circle tails. It's the easiest way to see the pattern as a whole. This is how you're going to be able to break down those core concepts, those individual advantages, guys, because those are the ones that are going to carry over. The goal is that you look at your large chart first. I can't stress this enough, and my buddy Pete's the one that said he'll minimize his small chart until the large chart says go, and I think that's brilliant. So learn the large chart looks, guys. Strong triggers and clear path. Go take 25 pictures each of strong triggers. Annotate. Why is it strong triggers? Don't just get the visual. Guys, get the visual and write the recipe. Smalls below large, colors match, scissors open, strong, odds favorable momentum. Know exactly what it means to you to have those strong triggers. Know exactly what it looks like and create that correlation between your brain and your eyes. Do it for all 4 of these. You won't make the mistake. You won't make the mistake of trading weakness when you believe it's strength or trading into a termination condition hoping it's a clear path. You're going to be solid, guys. Take those pictures. Get them in your spreadsheet. Give yourself 4 or 5 minutes of study before the day starts. This is exactly what I'm looking for, what I'm committing to. As you go through and take those pictures, This is the high probability trend trade checklist, guys. This is the best of the best way to take this trade. It's not the only way to take this trade. This is the best, the highest probability. Oh my gosh, it is sunshine and rainbows, and it all begins with a strong top or bottom. And what is a strong top or bottom? Guys, I define everything so that there's a correlation. A strong top or bottom is a no triggers through termination. Price reaches resistance, the triggers don't break above, and then it reverses the market. And this termination condition does not become a strong top until almost 10 bars later, but it does. And then this termination condition is only a strong bottom when it reverses the market, guys. And if it comes from a strong top or bottom, it's the highest probability trend trade you could ever take. And then here, it says that you have to have odds favorable momentum. This checklist says both charts. Remember, the best of the best. And it's always the separation, and it's never when the triggers are closed. And then you have to define your path. And guys, this is the one. This is the one I want you to spend a few days on. Know the difference between a termination, do nothing, the potential to break, gauge your advantages, manage assertively, clear path, go cat go. And then defining your entry. Triggers define the retracement, areas define the bounce point, your order goes a couple ticks below the lowest point, above the highest point. And if you try to get the lower point, you might miss your trade. And then finally, here's that same checklist, guys, and it's just laid out here for you to print on your desktop. This is what I want to see you writing on your chart. I want you addressing where it's coming from, talk about the momentum, talk about the termination conditions or lack thereof, and when you define your entry, use that language, area inside of favorable large triggers. Because nobody in the history of this checklist has been able to answer yes truthfully to all four and do worse than 70%. So if you're a brand new user, this is your path to success, and success is what breeds confidence. And then you need a plan. This is your plan. I promised you a plan. Here it is. It's the KISS plan. It's the Keep It Simple Sunshine plan. And guys, this plan is a stepping stone in your learning journey. It's the first trade. It is teaching you to read your indicators, to optimize your chances of success with the high probability trend trade. And you new users, I'm going to tell you right now, there have been people, there have been clients that in their first 30 days with Nexgen have gotten funded in those prop firms following the very simple KISS plan, guys, because it's been proven to win more than it loses. Through simulation, study, class feedback, continuous practice, guys, you're going to be able to write your own plan. You're going to begin to see more patterns. You're going to recognize things that can bring you success outside of this very basic plan. And that's when you begin to grow. And there's two things you have to know before you sit down to trade and you're not on simulator. Because if you're on simulator, mess it all up, break every rule, make every mistake, learn every lesson, and then when you go live, you'll be a better trader for it. You have to know why you will enter a trade. And the Sunday school answer is because my rules are met. Because my rules describe a pattern, and that pattern has been proven, not by Mark, not by Nexgen, not by Joe Bob Briggs here in the room, but by me. I've gone back, I've tested it, I've studied it, I've verified it, I've validated it. Now I'm learning to trust it. And there is no reason that I should not enter the market at the area inside of triggers when my rules are met. And guys, your rules are going to help remove the emotion associated with trading. And we all know fear and greed is a big thing. But guys, if you know that your pattern, if you trust that your pattern wins more than it loses, you know right then that you will take losers. And you accept that you'll take losers. And you don't get to pick when the losers will happen. One of my least favorite phrases is I skipped 4 trades because I have to start with a winner. Guys, you'll never know if you're going to start with a winner or a loser. The only thing you can control is whether or not that pattern is in play. And then you got to figure out when to exit. Management, guys. Management means that you have to exit a trade that you hope goes further. Management means that you have to exit a trade where your advantage has gone away, even though you don't know what's going to happen next, guys. And exits are either taken at profit targets or when the advantages that you had going into the trade are no longer present. So once you define your entry, you've described the pattern that wins more than it loses. You know exactly where to enter the market, and you know exactly where your stop goes, where the market shouldn't. That's management. And great traders, consistent traders, confident traders, manage their risk before they ever manage their profits, guys. You manage your risk by having strong triggers, and you manage your risk through not trading into areas that could stop the market, and you manage your risk from taking the correct entries. And now you've got to manage it. Now you're going to get into managing your profits. And the KISS plan management is designed around trading 2 contracts. Remember, you're on simulator. Trade the 2 contracts. Don't trade 100 contracts trying to get simulator rich, guys. Trade 2. And the KISS management plan is designed to help you understand and trust stop placement. And more importantly, it's focused on getting you paid. Because for whatever reason, once the excitement of the trade comes in, we forget that the goal is to get paid. And this kind of keeps you centered and focused on that. And you will create your own plan once you can read your indicators. And you'll find different reasons to move stops. And you'll find different reasons to go for bigger profits. But until you can do that, guys, keep it mechanical. Keep it as mechanical as your entries are. If then. And if your entry is 2 ticks below resistance inside of favorable large triggers, then your initial stop is 4 to 5 ticks beyond the triggers, guys. And you'll know your risk before you ever enter the trade, because you know that your stop goes where the market should not go if this is going to be one of those winners. And if I enter at 71.34, this is a crude oil look, my stop is at 71.49, which means that I have $150 per contract of risk. If you're not okay with that risk, skip the trade. Because if you try to put your stop inside of those trigger lines where the market may retrace, you run the risk of getting stopped out, taking the loss, and only watching the market run without you. And if you put your stop below an area of resistance inside of triggers, the same thing is true, guys. So learn to accept the risk. Understand that having risk is a part of trading. Sun Tzu in The Art of War reminds his readers that in order to be victorious in battle, you have to be willing to step into the kill zone, guys, and that's what this is. And if they don't get you, if they don't stop you out, more than often they won't if you're following rules, you get a reversal bar in the direction of the trade. And we can identify reversal bars because after all the down bars, that's your reversal bar, the up bar that sets off the entry. And then that down bar, well, this is confirming that the market is going down with momentum, that it's going down with a clear path, that it's going down from the best of the best area. And you're going to redefine where the market should not go because of that confirmation. And your new stop is 2 ticks. 2 ticks above that reversal bar. And guys, your risk is now $30 per contract instead of $150. And it doesn't guarantee a winner. And it doesn't promise you all the riches you could ever hope for. But what it means is that if the small crowd eats their Wheaties and pushes back up, that's a tiny little loser. And it's not uncommon to see Nexgen users taking great entries, using smart stops, and taking a tiny little insignificant hickey that doesn't upset the apple cart. If they don't hit your stop, guess what? We're getting paid. Your first target was at $100 away from your amazing entry, guys. And if price reaches that first target, one contract is automatically removed. It's off the table. The money goes into your account. You only have one contract left. And you're going to move your stop to break even. And I'm going to tell you, this isn't the best stop. But for the new user, this is the most important stop you could ever have. Because it takes all of the risk off of the trade right after you've been paid. Right when you're feeling good, when you're starting to feel confident, when your sweaty palms are no longer sweaty and your pulse is going down. And this stop, it teaches you to trust the large chart. Having zero risk makes it easier for you to hold for that second contract, to remember that the only reason you enter this trade is because of momentum and path. And the wonderful thing is, guys, is if it doesn't come get you break even, it means that it hits your second target. And once price reaches your second target, that contract comes off, and it doesn't matter what happens next. But you just made $300, guys. And that's not a $300 day. That is about 3 to 4 minutes of your life to make that $300. That is a fraction of your trading day. But if that was all you did, if you shut it down and went and swung golf clubs after that, $300 a day consistently is a $75,000 a year based on 252 trading days in a year. Take another trade, only make $100 on it, and suddenly you're in that six-figure income. Guys, the whole purpose of this classroom is to teach you to recognize a few advantages, piece them together to create a high probability trade, and find a way to make daily profits consistently, guys. And once you can do that, once you can make them consistently, the sky's the limit. There's people that use trade copiers. You could take $100 a day and mirror it on 10 accounts. You could use a trade copier. And then suddenly that $100 a day becomes $1,000 a day. And that $1,000 a day is $250,000 a year, guys. And that's pretty outstanding from only walking away from the playing field with $100 a day. You will, with a little bit of study, see the potential to make $500, $600, $700 a day. And you'll learn how to do it relatively easy if you focus on the plan, guys. If you keep focused on having advantages and you refer to advantages every time you take a trade. I promised you everything you would need, and there it is in a zip file. And that zip file contains the PowerPoint that I teach with every morning. That zip file has Chart Reading 101, teaching you to recognize those core advantages to make sure you understand them and build trust in them. It has the High Probability Trend Trade Checklist to give you a cheat sheet as you take those pictures and to remind you that if you can mark yes to each and every one of these, nobody has ever been able to do worse than 70%. I have had engineers put it through the ringer, and they end up around 83, 84% over like a 400-day span, guys. Inside of that zip file is your KISS plan, the highest probability trend trade entry you could ever take. The most pragmatic, emotionless way to manage that trade is you learn to read your indicators, and then it opens the door for the 50-50 trade. That's the second trade in the plan. And this one is designed to optimize your chances of success on a trade that is not perfect, which means that you have to understand that the path isn't clear. So having a strong top or bottom is imperative. Momentum on both charts is imperative. No divergence is imperative. And that optimizes your chances of success. And it has to be managed differently. All of that's inside of the zip file. You can download it. You can drag it over to your desktop, whatever makes you comfortable. And then before we get into the second half, guys, before we get into your charts, your chart reading, I like to go through this. And I like to discuss this. I wrote this out. And guys, I wrote this out for somebody that sent me an email that was frustrated about the 90%. They were so put out with having to wait for trades, waiting for the best trades, that they tried to find all the trades. And they tried to get into the market as often as they could. And I think most detrimentally to their success, I don't know if that's a word, they tried to trade like the people they saw in the room. And I'm going to tell you right now, guys, Pete's got 8 years on you. And if you try to trade at Pete's level, when you're a brand new user, you're not seeing everything that he sees. So build the foundation. The key to everything is a foundation. I can't stress that enough. When you understand momentum and path, guys, life gets good for you. Understand the basics, and then each day, each week, 1% better, guys. 1% closer to being at that level you want to be at. Don't rush the process. So for you new users, I blanket you with very conservative rules, the recognition of advantages, and I hand you a solid plan, a proven plan that optimizes your chances of success as you learn to read your indicators. So for you new users, all termination conditions are bad, and it has to feel that way. And areas beyond the triggers for entry is bad, and it has to feel that way. And no momentum is bad. And I want you to feel that way. And these blanket rules are in place because it increases your likelihood of success. And success is what gives you the confidence. And they're not always bad, and you'll see that as we get into the second hour. You'll see people work away around some of these challenges, but it's their chart reading that recognizes the challenges, that gets their management hat on, that makes them a little more aggressive. And then just like anything, guys, the more time you spend with the software, the more pictures you take, the more you post in the room, the more feedback you accept, it will open doors. You will see more. So I encourage everybody, learn the process that yields results. What's the process? The process is recognition of the pattern, commitment to the pattern, learning to manage the pattern. That's the process. It has nothing to do with wins or losses. It has nothing to do with the simulated money that you make. It has everything to do with following the rules. The results seem to follow. And that's where the KISS plan comes in. And that's why I hand out the KISS plan every day. If you keep it that basic, if you follow simple rules, and most importantly, if you're okay not looking for all the trades, only the best trades, you can find an extraordinary level of success. And I see it every day. And I've watched it repeatedly over the years, guys. So the further you deviate from the very simple approach, and I'm not saying that you're stuck on the high probability trend trade for the rest of your life, give it 30 days. Give it 20 trading days of focused on the best of the best, guys. Because the more you deviate from that as a new user, the longer it tends to take you to find success. So as we get into the second hour, question everything. Seek clarity on anything that isn't clear. But don't be the trade police. Don't say Bob B took a trade that doesn't follow the rules. It doesn't matter. It's Bob B's plan. He's not paying your bills and his losses don't affect yours. Focus on the good stuff. Ask a million questions on any chart that's posted, but give yourself a little bit of grace. And I'm talking to Bejoy and Aaron and you guys that are brand new and AFLAB and you folks that think that you should be a professional trader in the first week, guys. You're brand new. You're in your freshman year at college and you're learning a skill set that can change your life forever. So be okay with being new. And as we get into the second hour, guys, a million questions. There's a million opportunities for education, but I don't know if you need help if you don't let me know that you need help. And now I'm going to do my favorite part of the morning. I'm going to walk away from you guys for a second. I'm going to step away. I'm going to stretch my legs. I'm going to refill my water. And I'm going to pet my dog because I firmly believe it is counterproductive to sit in front of a market for hours on end, especially if your rules aren't met, because your brain will tell you that if you're not busy, you're not getting paid. So I'll be back in 5 minutes. When I get back, we're going to look at every chart that's been posted. Every chart that's been posted, I will address momentum, path, and entry. I won't judge you. I won't shame you. I will celebrate your victories. But even if you're one of my most experienced users and you know that you're trading into a termination condition and it's a part of your plan, I'm going to point out to the new users that you did not follow rule number 2. So don't get butthurt. Understand this is an educational room, and every chart posted in this room is a request for feedback, and my feedback always revolves around the 3 advantages. So I'll see you guys in about 5. Go stretch your legs. We'll see if weak triggers at a Fibonacci area has any effect on the forward progress of the market. Back in 5, guys. let's get to that second half of class. I don't know how it could be any more clear. I don't know how I can convince you guys that weak triggers at a Fibonacci area is not a recipe for a trade. If you decided to go long at this fib, guess what? Avoidable losses, guys. And one of the things that you're going to realize the more time you spend trading is that it's not this amazing win that builds P&L. It's not forcing that amazing win to make up for losses. It's not making $300, $400 and finding yourself up $50 because you had to trade into a termination condition. So just a little heads up, a little insider scoop. We are going to go through and I'm going to start clicking on stuff, guys. I'm going to start clicking on your links, your pictures, all the good stuff. And I want to address this one. Aaron put this one in as a test yesterday. And Aaron, I just want to say you passed the test. You had all the momentum, the trend is up, and the only thing that I would want you to put on this chart, Aaron, is that this area has the potential to break because of the momentum. This area is not quite a broken area. And you take the perfect no divergent, strong triggers, pull back to support inside of triggers, and just beautiful getting out at the area that could create problems. And man, I'll tell you what, a weekend, that is rock star solid. And BJoy, the same thing. You're identifying trend. You're looking at momentum. And the one thing, again, I just want you to say, hey, this area has the potential to break, but it's not quite broken, which means I may have to manage a little assertively. And this is one of those kind of pain in the butt moments where if you thought you were going to get in at the mid-band instead of the Fibonacci area, you missed your trade. Absolutely perfect. And the fact that you guys are recognizing already that resistance is a beautiful spot to take profits, that resistance is the perfect place to exit a trade and be willing to wait for the next trade. And then, BJoy, are you in here? Notice that when you actually took the trade into resistance, it didn't do anything. So taking these is beautiful. Taking that one is trading right into a brick wall, and you are driving a Yugo straight out of the 80s. And the likelihood of you winning that fight is slim to none. All right, we don't have a lot of pictures, guys. I'm gonna be wordy today. Chili dog with a huge slip in my favor. Wayne, you've been living kind of a charmed life with those chili dog slips. I love it, man. Couldn't happen to a nicer person. So what's he talking about? This chili dog. And I like this, guys. So the chili dog is a trade that was developed by a gentleman that studied the high probability trend trade, that studied those very basic advantages and realized beyond a shadow of a doubt that when the large chart has both momentum and a clear path, when there's separation between the triggers, when everything is screaming down, when there's nothing to create a bounce, it's pretty easy when all the charts match to ride that wave of momentum, to find a way to make money. And that's exactly what Wayne did. Wayne says, I have momentum on 3 charts. I have nothing in the way on that large chart, nothing to create a bounce. I'm going to jump in and just ride the wave of momentum until it's over. And that's exactly what he does. And then that divergence signals that it's over. And $760. And that was, I don't know, 20 seconds? Maybe 20 seconds? That's a happy slip, dude. That's a great... His target was up here at Fibs. And then the market went so far, he made an extra $500 because it slipped him. Outstanding, Wayne. Momentum and path. I don't know if I've mentioned that. When you have momentum and path, you'll find a way to get paid. When you have momentum and path, you've got the greatest advantages ever. When you can identify momentum and path, guys, you can create a plan outside of that high probability trend trade that is consistent, that is profitable. All right. So Wayne says, this is a 50-50 look. I have a strong bottom, and that's outstanding. And I have odds favorable momentum, and that's outstanding. And I have absolutely no divergence on a pullback. And a lot of you are saying, Wayne, dude, you got in late. Why didn't you take the entry at the areas in the retracement zone? And Wayne says, dude, there's so many lines. And Wayne, it doesn't matter. Get in at the high line, right? But that's not what Wayne was thinking too. Wayne says, I know where the market may continue, but it could retrace all the way down here. My stop has to go all the way down here. And I don't know that it was the multiple lines so much as it was the enormous risk that Wayne would have had to put on a trade that isn't even high probability. He's trading the potential of an area to break, and Wayne says, well, check out this smartness. I'll let it start heading the direction. I've got plenty of room to make money, and I'll get in on the good side of those triggers. Every indicator agrees, and it's easy money. And Wayne, it's that level of patience. It's being to look at the trade and say to yourself, this is more risk than I'm interested in, and not getting in at the high point and putting your stop 5 ticks below it. It would have stopped you out. Not getting in at the low support and putting your stop 5 ticks below. It would have stopped you out. You knew where the market could retrace, and it went right back to those large triggers. And you knew exactly where the market shouldn't go, and you just simply said, I'm not cool with that risk on a medium probability trade. And guys, that's one of the things you'll be able to do when you understand this very basic concept. And then you'll modify your entries if it's too much risk and still find a way. Great trade, Wayne. Momentum? Yep. Clear path? Yep. Strong bottom? I'm going to believe you. And then here's one of those instances. Momentum and path, and his areas are on the wrong side. Does everybody see that? The areas are on the wrong side of the triggers. His areas are where his stop goes. And Wayne says, I'll tell you what, if these areas are really going to hold, the market's going to change direction and start to head up. And Wayne says, I'll take it if it does that. And then if it never does, if it just keeps going, because it could, I don't ever get in the trade, and I love it. So Wayne says, instead of getting in on the way down, I'm going to get in on the way up. I'm going to force them to hold. And then it's easy money. Nicely done, Wayne. Great trading this morning, dude. And then Miss Jen. All right, reason for the trade. Odds favorable momentum. I like it. You had a clear path. So the perfect look, right? Odds favorable and clear path. And let's zoom in so you guys can see that, because there's a lot going on in her chart. That circle is her entry, guys. Strong triggers, clear path. And I want you to see something, and this is why language is important. There's no areas inside of triggers. All of the areas are where the market shouldn't go. And Jen says, well, I hope the mid-band holds. And when it started to bounce a little bit off the mid-band, she said, oh no, I better jump in, it's going without me. And they said, no, just kidding, you don't know where we're going to bounce. And they went up to the next area, and they went beyond the area. And by entering on the wrong side of the triggers, Jen didn't know where to put her stop. And that's a pretty good loss for breaking rules. And then when she actually gets the confirmation bar, when it actually prints in the direction of the trade, then you can re-enter, and that's exactly what she did. And then it becomes a little easy, forcing the market to confirm because rule number 3 isn't met. And then in at 62, out at 72, that $200 loss isn't made up for until right here. So she gets 100 of it back here. And then her profits start at 44. And you were out at 38. So net $60. Net $60, Jen, because you didn't force confirmation, you let them trick you. Does that make sense? And that kind of goes back to the thing, and thank you for always being such a good sport when I point stuff out like this. Guys, if you don't have an area inside of triggers, if you don't have an area inside of triggers, you don't know if, when, or where that market's going to bounce. You just don't. And you like to believe that you do, but you don't. So one of the things you can do is you can force that reversal bar, because the reversal bar gives you something to put your stop behind. It doesn't guarantee a winner. You're on the wrong side of things. But if you try to anticipate the reversal bar, it looks like that. And Jen, I hate to admit it in front of everybody, I used to try to anticipate reversal bars all the time. And it worked out. It was like 80% of the time I was wrong and I got a loser and I had to take the trade twice. And having to take the trade twice because you lack patience, it's the difference between making $300 or what is it? Making $260 and only making $60. Big difference. Great read. Just need that little bit of patience. And guys, I see this a lot. When you try to anticipate or they scare you into believing it's going down, remember, this is a tiny little chart. You're going to see fluctuations. Great large chart read, Jen. Good opportunity for a little bit of growth. Weak triggers, multiple divergences, shenanigans. What a great word. Shenanigans. And that's exactly what it is, guys. On the small chart, you can see the large chart indecision. And Jen says, I'm not going to get caught up in that. I'm not going to hope. I'm not going to wish. I'm not going to want. I'm just going to force them to give me what I need. And then here's Pete, strong bottom, odds favorable, and he's in around 18, which is before it ever gets to trouble. And he's out at trouble. And pow, great job. Riding momentum and path, finding a way. Great job, Pete. I mean, there are not a lot of pictures in here. Joel, if you're sitting on pictures, brother, start posting them. I need the help. I know you've got 30 of them you want to share. Let's do it before the end of class. All right, and then directly into termination conditions. And guys, this is kind of my example. There's from 14 out at I don't know, 27, 25, make a little money, and then trade directly into termination conditions, and that's a tough one. Do you need to trade into termination conditions to be successful, guys? You just got to ask yourself that. Large chart's not still good. I'm going to disagree 100%. 100% I'll disagree. A termination condition is not still good. It's just not. You're making a calculated choice as it relates to the trigger look, but triggers are 1/3, Pete. It's 33% of your advantages. You have no clear path and you don't have any areas inside of triggers. I know you know, but I have to do this for class. If you don't want me to mention the termination conditions and the fact that you entered on the wrong side of triggers, don't put it in the room. I have to. 2/3 of the advantages are gone. Because of Pete's ability to read charts, he's able to capitalize. New users don't tend to be that lucky. Great job, Pete. I don't ever beat you up for your plan. I know your plan. I know your abilities. But I got to do the teaching hospital thing. Odds favorable, clear path. Everything is great. Perfect entry, easy money. Cav, it doesn't get any better than this, does it? Odds favorable, clear path, perfect entry, easy money. Great job, dude. That's such a nice trade. Take that trade. You go do something else with the rest of your day. $1,000 goes a long day, or a long way. Now we're up above it. Traded into the termination, had to manage out. Trade into the termination, have to manage out. Once you get above the termination, it's easy to make money. Large short weakening. I don't know. Small's outside. Now you have a clear path. Now you have a pullback. And look at that. It worked beautifully. The easy one was easy and it was fast. Guys, this is such a great lesson. Well, wait, I figured Joel out. Joel doesn't want to jump in front of all the people that are posting individual pictures because he's a nice guy. So he holds them for the last hour. But I'm running out of pictures, so I knew Joel would do me a solid here. And this is the perfect trade. And if you had just been a tick or two above support, it's easy money. But that wasn't your money. Great trading, Pete. Great trading. There's a couple of you that I just don't worry about. Why I took this trade? Strong bottom, odds favorable momentum, not a 50-50. You did have a rules-based entry area. Broke the rule trading into terms, so you managed aggressively. But I don't know that you managed aggressively because you got divergence from the same fibs you were hoping were going to break. And you weren't break even when that happened, which means that you kept your stop in place, even though you had divergence on a 50-50 right from the fib, and you end up holding it, and then when everything starts twisting, you still get paid. Nice job, Bob. And what's cool is if you would just pump the brakes and said, that's not my trade, the easy one was right here. Isn't that crazy? I don't have to trade into termination conditions. Let me be patient. The next trade's coming. Guys, when you believe that the next trade is coming, it builds patience. If you feel like you have to be in every move, you have to trade into termination conditions, you have to fight momentum. Guys, if you feel like you can't get paid without breaking rules, you're mistaken, but you've got to learn to trust it. Jen, look at this. Odds favorable, clear path. Rock star entry. First profits taken. First target's 50. Should have been 100. I agree. And then just a couple ticks below the fib. Beautiful trade, Jen. The next trade is coming, right? Trading's like a bus, or I guess girlfriends. You lose one, the next one's coming. Jen, perfect. Is your ATM not preset? I mean, gosh, this is beautiful. Such a great trade. It is now. Right on. Not a Nexgen trade, not a new user trade. I love the disclaimer. Took this trade for several reasons. I had weak triggers at a fib. Divergence from that fib. And it's a little counter trade. And it goes right to the trouble area. And it's nice. It's a good looking trade. This is trading the idea that weakness at a fib is more likely to stop the market than it isn't. And that divergence kind of confirms that things are slowing down. And I like this because Pete says, let me at least let the small triggers roll. Pete, that's a pretty cool trade. And you're right, that's not a new user trade, but dude, you absolutely nailed it. All right, 1, 2, 3, 4, 5, 6, 7. All right, Joel, I'm going to call the shot right now. I'm going to call the shot right now. I'm going to say that when you had momentum and path, you're going to find an extraordinary level of success. And any losers I see on these 7 charts will probably fight the triggers in some form or fashion. Let's see what happens. Not a bad top. Perfect termination condition, Joel. 100%. Perfect termination condition. Price reaches divergence high. None of the triggers break. Beautiful termination condition. And then it pushes back to the midband. And now you're above the triggers. You're above the small triggers. There's no momentum down, so you're not fighting triggers. And on your smaller, faster chart, you take the divergence, the termination, you wait for it to trade in favor to get that odds favorable momentum, and you ride that wave of momentum up to the problem area. All right, Joel, I'm 1 for 1. Your patience, waiting for the triggers, not fighting the triggers, there's a beautiful victory. Everything says up with momentum, beautiful victory. 2 for 2, Joel. Everything says down with momentum, victory again. 3 for 3, Joel. Momentum down. Oh, you're close to the termination, but not quite there. Momentum down, you get in. And quick profits and outbreak even on the second. You gave it a shot with all that luck. Absolutely beautiful. 4 for 4, Joel. And for those of you that are wondering why I'm playing with Joel, Joel and I have been working on this for the last week or two, right? We've been having the conversation every day. He's done an outstanding job of posting in this room, and one of the things that I'm good at, guys, I can recognize patterns on a chart. I do a really good job with it, but I'm also pretty solid at recognizing patterns in you. The things that you do to bring success and the things that you may be sabotaging yourself with. Joel, odds favorable momentum. It's mirrored on the small chart. Easy money right up to trouble. 5 for 5, is that right? Odds favorable, clear path. 6 for 6, Joel. Are you hiding trades from me? Odds favorable, clear path. 7 for 7, Joel. Are you hiding losers from me, Joel? Or are you really being that patient, insisting on the best? Not at all. So you posted 7 charts. In 7 charts, 7 winners, and every one of them, odds favorable and room to targets. That's for you, brother. Great job, dude. You're very teachable. You are very teachable. And that took what? So last week, we recognized the problem, the challenge. It took about a week to work through it. And I would say, Joel, that now you believe it. I would say now you believe that with all that momentum and a clear path, it's going to be difficult to not get paid. I think Wayne believes it too. Because with all that momentum and a clear path, it's hard to not get paid. Wayne, this is beautiful too. I need to save that gold star picture and start dropping them in the room. So Aaron and Bejoy, and who else is new with me in here? I was supposed to have someone named Nosebleed in here, but I don't know what happened. I want you to become a believer. I want you to be a believer. When your large chart says that it's screaming in the direction with nothing in the way, the odds of you finding a way to capitalize and make money are huge. And we just keep seeing it over and over. With odds favorable momentum and nothing to the next area, it's almost criminal how easy it can be. Holding yourself a little longer, learning how to chomp that bit and not jump into it. All right, Wayne, odds favorable, clear path. And you catch it on the way down as you do. I like it. You take quick profits. And 2 divergences. Here's a great lesson. 2 divergences with the highest probability trend trade doesn't necessarily constitute an exit. 3 divergences says get the hell out. And Wayne, I don't understand your stop. I don't understand. I mean, break even, I could get okay with, right? I took profits, go break even. But this, why lose? Why bother losing? Because your rules say get in again on the way down with this look, right? And even here, your rules say get in again on the way down. And that's one of the things that you'll begin to do as you grow with the software is when you start working on management, you'll start saying things like, man, don't put a stop where the market could go. Put the stop where the market shouldn't go. Like, I would never be willing to lose with this look. Everything's in favor. And I know that you have a plan, but that was the perfect entry for a high probability trend trade. That was the perfect entry for a high probability trend trade. And then that's the one that stopped the party. Does that make sense? It was a flash before you can move the stop. Well, that's fair. That's fair. Gold has been cranking lately, hasn't it? I've seen a couple of you guys with your trades that are like seconds long. And I'll just tell you right now, it's pretty kick-ass to be able to make money in a couple seconds. Good stuff. Thank you for telling me that. So you probably recognize that's not the best stop. But if the market's moving too fast to move it, then the only question that you have to ask yourself is am I willing to trade a market where I can't get my stops in the right place on time? Strong triggers, potential to break, no divergence, perfect entry, and then when divergence prints, that 50-50 trade is more likely to fail. Great job, stopped out for 20 bucks, quick profits. I'd do that all day. How amazing is it to be able to take a trade that fails and still get paid because of your great entry, because you gave yourself room to get paid. Nice trading, Wayne. You guys are awesome. That's all the pictures. What's the live market doing? Let's go see. Well, what a great learning lesson. So check this out. First of all, termination conditions worked. Do you guys see how price just rails away from those large triggers? Accelerates away from those large triggers and hits a termination condition, hits the mid band, hits a fib. Guys, I want you to take note. Your large triggers are above the reversal bar marker. And what that means, this is what we call the gap theory. This is a good lesson. This defines a mid band as a termination condition. If I hit a mid band and the large triggers are a full bar away, in this case, above the reversal bar marker, that's what that gold line is. It shows you where that bar will become an up bar. Mid band is a term, guys, and that's how you define a mid band as a termination on the large chart. This is called the gap theory. The exact same reason we look for entries inside of that retracement zone, because price tends to close the gap to the large triggers, is the same reason. Even though you have this momentum, you're not looking for that short trade yet. And guys, I'll give you this picture. Put it in your spreadsheet. Use this as a study tool. Go back and become familiar with this look, because it says don't go short yet. We're into trouble. Don't go short yet. It's a termination condition. It could bounce. It could do things. And we'll see what it does. But very often, guys, especially when these divergences start printing, it becomes problematic. That's what we call the gap theory. That defines that mid-band as a termination condition. Jump the fudge in, then momentum, trend trade. So odds favorable momentum, clear path, and Wayne says, I'm going to see if I can get that whole just jump in and ride the wave, and then that reversal bar prints. And Wayne goes, Carn sarn it. That lets me know momentum is gone. I'll take a little hickey here. That's okay. No big deal. And then as it starts back up, he says, I'm going to ride that momentum. And he rides it, and he gets paid. And then when they start dancing as the momentum goes away, he makes a couple bucks and says, all right, that's it. I give. I've done what I can do. I made it back. I rode the wave, and it didn't work, so I tried it again, and I made it back. And it's just dancing. And because it's dancing, because my small chart isn't giving me momentum anymore, I don't know what's going to happen. I don't have that advantage anymore. I'm just going to sit on the sidelines and wait and see. I'll let it get perfect again. And man, what great patience, Wayne. Take the perfect trade. And even if it doesn't work, he doesn't go, oh no, poor me. I'm going to sit on the sidelines for 40 minutes and pine about it. I'm going to get back in the game. I'm going to ride that momentum. I'm going to find a way to get my money back. There was a time in my life long ago, I was much younger, more flexible, and probably better looking. And I raced motorcycles. And Wayne certainly understands this one. He did too. There was a novice class and there was an expert class. And when I was a novice, I was brand new. I had an expert tell me. He told me, he goes, Mark, he goes, it's weird. He goes, the difference between a novice and an expert isn't lap time so much. There's a lot of really fast novices and there's a lot of slower experts. He goes, the difference is how quickly they recover from mistakes. An expert, someone with the seat time, with the repetition, with the time on the pond, as Pete says, they'll make a mistake or they'll take a loss and they get right back focused on the game and they don't worry about losses because they know losses are a part of it. And the novice, the new trader, will begin to second guess everything. I know it was the perfect trade and it didn't work out. And now I'm not sure that it's the perfect trade anymore. I don't have that trust built up. And what happens is the longer you're in this game, guys, the longer you see these patterns, the more you see them, the more you take pictures, the more you practice, you realize that losses really aren't a big deal. And you get right back in the game. I had the exact same thing this morning, guys. I'll show you the picture. I had the perfect trade, and I took the perfect trade. And it whipped my ass quick. But every indicator on all of my charts still said the market was more likely to go down. And there's that gap theory. So I traded the gap theory, and I took profits when the gap was closed. And I took profits securing it, guys. And I literally chased this market all the way down to a zone that I had on my trading view. And that little $300 loser turned into a $1,300 winner because I kept my head in the game. And that's just, it's an experience thing, and you'll get that experience. Wayne, no momentum, against the trend, wrong side of the triggers, not even the gap theory. I don't know why you went long. I'm sure you had a reason. I'm not sure what the reason was, but I'm glad you got paid. The chili dog fail was over here. I see a long here. And then it came and got you. Tight stop. And man, that's just a bummer because you had it dead to rights. And then this is the, all right, it's been 12 seconds. I need to find another trade to be in. And when the market moves that fast, it's hard to not get excited. Yeah. And you guys will see that. When the market is really cranking fast, you'll get excited. I've watched a lot of people lose a lot of money trying to trade news. Because the market is moving so fast, you believe there's going to be something. And you start fudging a little bit. And you pulled one off here. Good job. I'm glad you win, guys. When you get lucky, I'm glad you get lucky. And then I noticed things, and Wayne, just forgive me. Tight little stop on the perfect trade. Big old honking loose stop on the not perfect trade. That's pretty common, guys. And you know what that is and Wayne, you're awesome for letting me make this rule for the new, or this lesson for the new rule users. When it's perfect, you follow your plan. When it's not perfect, you rely on hope. And this is such a real thing. When it's perfect, you're okay getting stopped out. When it's not perfect, you've already instilled the hope factor and your stops get bigger, right? And your targets don't make sense and you hold a little longer and all these different things. And it's not that Wayne did anything wrong, right? Wayne's responsible for his own actions. But having these two side by side is such an awesome study in human psychology. And guys, that's one of the reasons why I say every morning, go back and study your trades and ask yourself what worked and what didn't work. And there's a reason that I say, what feels easy? What feels relaxed, guys? And you will find over the course of time, it wasn't. It was almost the gap. I almost didn't get herpes, Wayne. It was so close. But I did. And now I'm stuck with it for the rest of my life. Not really. But what happens, guys, is if you go back and you ask yourself these questions every morning, and the whole relaxed and nervous thing, this is because you're going to begin to recognize it in yourself when you're breaking your rules. And guys, back me on this if you have a little experience. When you're breaking your rules, you'll feel your pulse rise. And when you're following a pattern that you trust that's proven, you'll find that you tend to stay calm. And when you're breaking your rules, you'll start keeping bigger stops because you hope that it works. And when you're following your rules, you'll put your stops where the market shouldn't go. And when you're breaking your rules, your brain says, hell, we're already breaking rules. Let's hope that all these areas break and hit bigger. You looked at the chart and you were trying to find a reason that you took the trade. Yeah, I'll do that too. And Wayne, I'll tell you, in my own personal life, and guys, I certainly don't mind sharing the challenges that I've had. In my own personal life, I will annotate a chart and watch this. And I'll show you how I would do it. And guys, some of you may identify with this. I'll take a long trade right here. And the real read is no momentum and a term, right? And the real read is no area inside. And I don't have one rule met. My opinion was that the market should go up from this midband because I want to make money to the long side. So the way I annotate the chart is I say that I had momentum, even though I didn't. And I say that I had no termination, even though I didn't. And I'll literally annotate my chart area inside of triggers. And why am I doing that? I'm doing that because it makes me feel better about this loser. Well, it was a good trade. All my rules are met. This one wins more than it doesn't. And I know that that's true because I believe me when I say I had momentum and no terminations in area inside. And guys, this is one of the reasons why I ask you to annotate your charts. This is one of the reasons that when you post in the room, I ask you to tell me what you saw. And what happens, and it bugs you guys sometimes, I know that it does, is we talk about the honesty that you're having with yourself. If you pull up that high probability trend trade checklist, and some people will actually post it on their charts, and I love that. They'll take this checklist, and if you have Snagit, you can do this. And they'll just take a picture. I need that bigger. They'll take a picture of their checklist, and then they'll go back to that trade, and they'll go, well, yeah, I had a strong bottom. You didn't. And for sure I had momentum, and I didn't. And you better believe it. And Mark, I checked yes all the way across the board, and it's still lost. And there's got to be honesty in annotation. That's such a great lesson, guys, I think. And it's still a termination, right? And they're bouncing, and they're struggling, and they're fighting, and divergences are printing. And it's just not perfect. You're worth perfect. So I'm going to take a break. I'm going to take 5 minutes again. I'm going to go stretch my legs. Absolutely no trades into support because my rules aren't met. And then should have been over here, right? Odds favorable, clear path. Well, that's pretty. And it's coming from a termination that reversed the market. I'll leave you guys with this. Let's see what it does. That sure is a good looking trade though. And a lot of you are already up $100, I hope. So I'll be back in 5, guys. Go stretch your legs.